Hi there, traders. This is Brad Goodwin with the Daily Market Insight for Thursday, the 23rd of September. All right, now just to give you a bit of a recap so you understand exactly what the Fed have come out with, what the reactions were, and see if we can piece it all together. To me, it makes complete sense what happened. So the Fed have come out, no specific timeline to when the tapering was going to start, right? That's dollar negative, right, initially, because everyone was sort of geared up, getting long dollars because they were going to give us a timeline. No specific time. And then they turn around in their comments and say, well, we're on track to raise rates in 2022, right? That's the real kicker. So the dollar came back very hard and aggressive on that. If I just give you a look at the currency pairs, you can obviously see here on the dollar index, if I just get that up, wrong page. Okay, so a bit of a dip and then back up, right? You can see the sort of initial move there, but that's, let me go on to the bigger charts and you'll see this a bit clearer. Now, if I just widen out a few of the charts here, you'll see the reaction, right? That initial dollar weakness, euro, sterling, both hung on to those resistance levels, right? Had a bit, the difference here between what euro and sterling did and what Aussie did, Aussie was right at the level of resistance when it came out. So it popped above, took out the stop losses, almost 35, 40 points above. Same with the Kiwi, right? Dollar CAD dipped down back towards support. Now, the whole thing was, to me, and I was saying this yesterday, if they don't give us a specific timeline, the dollar should fall. We'll come back and test these resistance lines on the dollar block, okay? And on the dollar pairs, specifically dollar CAD, I wasn't really focusing on dollar Swiss and dollar yen. That's sort of caught up in a bit of a safe haven trade. And even the dollar index, excuse me, buying on dips. Now, that would be because they haven't given us a specific timeline, but the plan's still the same. They probably want to see what the non-farm payrolls are doing. Now, instead of that happening, we got an extra overlay, which was, okay, there's no specific timeline. We're going to start as soon as we can, but we're going to raise rates next year, or we're on target to. And that's where the dollar really came back and rallied hard. If you knew the first part of the trade, well, then, you know what? It comes back and tests resistance on the dollar block. These pairs down the bottom here, euro, sterling, Aussie, Kiwi, right? If you're on the Aussie, you'd already been cleaned up, but you got to understand that before the trade comes out, if it's right on the resistance line and the announcement comes out, of course, it's going to blow to the top side. Same with the Kiwi, right? The good one is euro and sterling, which had a bit of work to do to get to that resistance line, pulled up. Then the kicker is, you know what, we're going to raise rates next year, and down the dollar goes. So what does it do for us? Well, to me, this is like a really good double whammy clean out. It cleans out a lot of stale positions, right? And what I mean by that is stale dollar longs, so that they will have to come back into the market and reinvigorate, give it fresh flow to the downside. What we are going to, I think we see dollar strength, right, for the short term, and really a massive build up in the next month's non-farm payrolls, because that's the kicker. If the non-farm payrolls are strong, this is on. They've come out in their statement and everything else they've said. They're basically, we're on track. We're looking for maximum employment. No, they haven't been specific with giving us a clear timeline, a clear number of what maximum employment looks like. But if you come down here and scroll down through your news, right, come down to the time of the release, you can see everything they're talking about. And it's very good to go through and read every component. Like, for instance, we've been muddling over the impact of Evergrande, right? This fund or real estate fund in China, massive issues with debts, over 300 billion, I think it is. Well, the Fed's actually come through and identified here, situation seems particular to China, right? So they go through what's happening domestically, give you the points of what they're doing and why they're making decisions. They look at the global aspect of what's happening. And this Evergrande thing is like a couple of days old, right? They are already addressing that issue and do not see a contagion issue in the States. That should really settle things down, right? You come back and have a look at the various financial markets. The fact that they haven't given us a timeline for tapering took the pressure off the equity markets. Equities rallied, and that coincides with the yields falling, Okay, so that's a very clear aspect. What wasn't clear was what were the currencies going to be doing. That's where your knowledge around what the expectation of what the Fed were going to do. Will they going to give us a specific timing for the tapering or not? If they don't, the dollar falls and the currencies rally, right? The kicker, obviously, as I said, was the fact that they said no, no specific time just yet, which means they are waiting to see next month's non-farm payrolls. But we are looking to raise rates in 2022. So I would expect the yields over the next week to start coming back and pressure to come back on the equity markets. But for now, that's this correction here in the equities is just a correction from a part of the move the other day. Notice it's not up 2%, like it was down 2% 2 days ago. This is just a minor correction. There's a bit of weight off the equities just for the moment, but you know what? They're on track. They're looking to raise rates in 2022. Non-farm payrolls next month will really determine what's going on. So I'd expect as we get closer to that, we've got like, a week and a half, 2 weeks before the non-farm payrolls comes out, you'd expect the treasuries to come back into play. I still think the trade from here, and it's very hard to be second guessing and say, oh yeah, get in on that rally. I mean, that's a hard trade, and it's easy to cherry pick these things. But now that we've seen a bit of a top, I would be a lot more comfortable selling or buying dollars, selling euro, sterling, Aussie, and Kiwi for that matter on rallies, right? There's nothing really going for those countries. The US has got a clear timeline for managing the economy, and that's a plus. So I'd expect the dollar to start going up from here or looking to buy on dips. Swiss and yen, I think they'll come back into the dollar trade. At the moment, they've been toing and froing between dollar trade and a safe haven trade. Dollar CAD, well, oil rallied again, which is going to put downward pressure on dollar CAD. But so it's going to trade sideways for now until we get clearer direction. That correlation between oil and CAD, obviously very close. I like to trade the CAD when they're both working together. At the moment, they're sort of discombobulating. So we'll have to see how that goes. So right now, to me, we do have dollar strength in the market. So from here, right, I would be looking at the releases coming out for the rest of the week with, this isn't as clear buy as to say, they come out and say, we're going to start tapering in November and we're also raising rates in 2022. Well, that's like a double whammy. The dollar would be through the roof. We haven't got that kicker. The non-farm payrolls will be the kicker, but we do have strong dollar bias at this point, which allows us to take advantage of the upcoming releases for this week, right? So we do have like a strong dollar bias. We get weakness. The idea is to get one currency weak, one strong. We get weakness in some of these Eurozone numbers. It feeds into the lower downside move of the euro. If these numbers come out strong, well, it sort of counterbalances a bit of the dollar bias strength at this point. So make sure you have a look through the rest of the week. Obviously, today is going to be important for sterling. We've got the Bank of England in play. Now, still think they've got their hands full. They haven't really come out with clear plans and direction of what they're going to do should unemployment hit levels or inflation hit levels. They are still sort of in rescue mode. Maybe this is the meeting where they come out. I'm not sure, but it's worth having a look. And then you can sort of piece together as we go through the rest of the week. I know dollar CAD isn't exactly clear at the moment, but we've got Canadian retail sales figures coming out today as well. You got the weekly jobless numbers out of the US. And then as you come down through the week, we've got some other PMI data out of the US. Wouldn't be worrying about those trade balance numbers out of New Zealand. And then you're having a look through Friday, some home sales, etc. A few bits and pieces, but nothing huge. The IFO is a good, the German IFO number is a good number to finish the week with on the euro, right? I would approach it with a strong dollar bias, put the other currencies together and see how it pans out. What we're looking for is the yields to stabilize, right? Maybe hit some sort of low point where they start sort of coming back. If you have a look at the yield curve, you'll see that that's flattened out. And if we come back to the volatility index, you'd expect to see this a little bit lower. The Fed's out of the way, which it is. We've seen that sort of spike. Okay, if I just bring that across. And I think this stabilizes, which means the market understands what's going on. They understand the Fed, the dollar's starting to rally, and we go from here. All right, guys, lots of questions answered from the Fed, especially with regards Evergrande, this Chinese real estate fund, and a whole range of things. If anything, what I would encourage you to do is come back and have a look across. Like, there's a huge amount of data here from the Fed, right? So go back to the time of the release. You can come back down through this and actually start going through everything they're talking about. They want to make it clear and transparent. What I found was really interesting was there was the Fed regional president trading equities, right? Imagine being part of the Fed and knowing exactly what the signals are going to be, and then trading equities on the back of that. There's got to be some massive. They're going to do a bit of a clean out of what's going on, policies, etc. But I mean, that's like insider trading, right? Anyway, have a look through that, because these are the answers. And by reading these, next time the Fed has a release, you'll be able to come through and watch and read what they're saying and be able to interpret it to manage your positions and take action quicker than sort of waiting for someone to tell you, hey, look, this is strong dollar bias, get long dollars, or vice versa, right? The whole idea is to show you how this is released, and then you get a clearer picture of what's going on. Fed's power, taper will be gradual, right? That's comforting for the market. The market doesn't want a knee-jerk reaction. Again, they're going to take everything out very quickly. That's to calm things down. So you've got to read into the releases to get the answers, right? This is, to me, a more of a defining meeting where they've set out even a clearer timeline, a clearer plan. When are they going to start tapering? Well, we're not sure just yet, but it's not far away. To me, and they do go in, when you go through this, you'll find it, they are looking for maximum employment. That's the signal for them to start, we'll set a guideline for the tapering. So next October's non-farm payrolls is going to be huge, right? That's going to, and it's, I know there's like 6 or 8 variables, but it's going to be easy. If the payroll change is big, unemployment's lower, we're on. And that's where the dollar's going to really shoot to the top side. Or if it corrects, well, then we're back into a waiting phase, but the plan is still the same. All right, guys, that's it from me at this point. Looking at today's trading, there's those German manufacturing and service PMI numbers for Eurozone and Germany. Bank of England's obviously going to be the key to it. I'd be tuning up my charts on sterling and all sterling crosses. See if you can make odds and ends of this. This is a lot more convoluted than the FOMC. To me, I mean, I'm not exactly sure what they're up to, but I know that this big, massive economic euphoria boom that they're going to have after everyone got vaccinated is not happening. Pressure on the downside in sterling. I can see sterling dropping like 10 cents over the coming months, right? There's nothing to hold this thing up, right? And everyone's been vaccinated, but there's more cases than ever. So, you know what? Economic growth, I don't think it's going to happen straight away in the UK, and that'll probably slow the Fed down from talking about tapering or rate hikes and the like. But we'll have to wait and see how that plays out. And that's pretty much it, guys. Retail sales in Canada, some PMI data out of the US. We'll see how it plays out. All the best, guys. Cheerio.